Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're taking a deep dive into a stack of pretty critical sources. They paint a fascinating picture, really, of the global financial landscape as of today, August 20th, 2025. Our mission, like always, is to cut through the noise, pull out the most important bits of knowledge, and, connect the dots for you so you can walk away feeling truly informed, ready for the day. We've got quite a bit to explore, actually. Everything from these big shifts in global currencies, central bank independence, to major corporate moves, and that ongoing geopolitical dance.
Indeed. It's a packed agenda today. We're pulling insights from publications like Barron's and Bloomberg, among others. And what's particularly insightful, I think, is how headlines that seem separate, at first glance, actually reveal these deeply interconnected themes, these underlying trends that will, undoubtedly shape markets in the months ahead. We're not just reporting news. We're trying to understand those deeper currents.
Absolutely. Okay, let's really get into this. Maybe start with a really foundational topic, the U.S. dollar. Our sources are highlighting a pretty significant shift in what's driving the dollar's weakness this year. It's a different story than just a few months back.
That's precisely right. According to Barron's, in an article they titled, "A New Force is Driving Dollar Weakness," strategists like Jens Nordvig from Exante Data and Mark Chandler at Bannockburn Global Forex. They're pointing directly to the Federal Reserve now. You'll remember earlier in the year, it was mostly about tariff policies from the Trump administration. That was seen as the main force causing dollar sell-offs, reallocation away from U.S. holdings. But, the narratives change. Now it's this clear expectation, really, that the Fed's going to resume interest rate cuts next month. Probably looking at a quarter-point cut, maybe twice this year, potentially starting, September 17th. That would bring the Fed funds rate range down to 4% to 4.25%. So this dovish outlook is really changing the market's view on the dollar.
Okay, so if the Fed is set to be more dovish, that sounds like it's really putting pressure on the dollar. I mean, it's already been trending down this year, right? Down about 9.4% against a basket of major currencies. Nordvig expects this weakness to continue, maybe more gradually, though. But Chandler, he sounds more bearish, suggesting another 5% decline, maybe even 10% if the Fed cuts aggressively, which, brings up a critical question. What about Fed independence in all this, especially with these strong political winds pushing for cuts?
Right, and this is where the story really gets, layered, more complex. There's a Bloomberg article, Powell's global peers to cheer for Fed in rebuke to Trump, and it reveals that these concerns about the Fed's independence, they've been really amplified, especially with the upcoming process to replace Fed Chair Jerome Powell next May, who's seen President Trump criticize Powell repeatedly for not cutting rates, even saying current rates make debt payments unnecessarily expensive. It even went so far that Treasury Secretary Scott Bessent publicly called for a half-point cut just last week. So the political pressure, it's undeniable, very public.
And what's really striking from what we're reading is this idea of global central bankers kind of rallying around Powell, or at least showing a united front at Jackson Hole soon. Is that right?
Absolutely, yeah. That's exactly the sentiment being highlighted. Leaders like Christine Lagarde at the ECB, that's the European Central Bank, Andrew Bailey from the Bank of England, Joachim Nagel from the Bundesbank in Germany, they're all expected to voice pretty strong public support for Powell, and, by extension, for the principle of central bank independence itself. They fundamentally see this independence as, part of their operational DNA, absolutely essential for keeping inflation in check, long term. And this isn't just theory for them. The Bloomberg piece mentions an ECB paper pointing to, quote, devastating effects in places like Turkey, Brazil, Colombia, where undermining central bank independence led to real economic instability. Powell himself actually gave a really impassioned defense of this back in April at the IMF, the International Monetary Fund, which apparently got a standing ovation. So, the official theme at Jackson Hole is labor markets in transition, but the underlying message, the powerful one, is going to be about nonpartisan monetary policy, the critical importance of central bank autonomy.
Okay, so we've got a dovish Fed, or the expectation of one, and this big debate around its independence driving the dollar. So how does this broader dollar weakness translate for other currencies, particularly for emerging markets? What does this all mean for investors looking globally?
Right, if we step back and look at the bigger picture, the dollar's weakness has a really profound global impact. Bloomberg has a piece, Citi says, biggest carry trade rally in years has longer to run. It highlights how buying emerging market currencies against the dollar, their carry trade strategy, basically borrowing in low-rate dollars to invest in higher-yielding EM assets. While it's delivered exceptionally attractive returns this year, there's a Bloomberg index measuring these carry trade returns from 8 EMs funded by short dollar positions, basically betting the dollar falls its climb more than 10% this year. That puts it on track for the biggest yearly gain since 2017. Brazil's real, just an example, was up over 20% against the dollar. Really shows the trend. Citi's Luis Costa thinks this can continue, mainly because of the dovish Fed and, the more cautious stance from EM central banks themselves. But actually, this raises a big question for a lot of people. Could this rapid rise be forming a bubble? Is it maybe poised for a sharp correction?
Yeah, indeed. We've seen HSBC strategists suggesting exactly that this relentless dollar selling is starting to look, quote, increasingly like a bubble that could burst. So there's definitely a debate there.
Exactly. And Costa, even though he's bullish, does add a note of caution. He says the outlook could definitely get more difficult in the second half of next year, particularly if these loose financial conditions end up pushing the U.S. economy into a stronger rebound than people expect right now. Plus, we're seeing some immediate headwinds for emerging markets, too. Bloomberg highlighted this in EM assets set for worst drop in 3 weeks as tech rout weighs. Just recently, EM stocks and currencies saw their biggest drop in about 3 weeks, mostly driven by a sell-off in U.S. tech heavyweights. Taiwan's dollar, South Korea's won. They led that retreat. It just underscores that even if long-term trends favor EMs, they're still vulnerable to short-term volatility. Shifts in global sentiment, especially from tech, it's a complex mix of forces.
That's a really thorough look at currencies. Thanks. So as we think about these big currency shifts, how do they ripple into specific trade dynamics? Particularly thinking about the U.S. and China. Treasury Secretary Scott Bessent had some interesting comments recently on the tariff situation.
He certainly did. And his remarks give a fascinating glimpse into the administration's current thinking on trade. Bessent says China tariff status quo working pretty well. That's from Bloomberg. Bessent indicated the U.S. is, maybe surprisingly, satisfied with the current tariff setup with China. He said it quite plainly. We're very happy, and the status quo is working pretty well. He specifically noted China is the biggest revenue line in the tariff income. So this might signal some easing of tensions, maybe even create an opening for a Trump-Xi summit before that trade truce expires in November. It's also worth noting, S&P Global Ratings suggested these tariff revenues could actually help soften the blow from the president's tax cuts on the U.S. fiscal health.
So stability, or maybe just a reliable revenue stream, seems to be the goal for now. But there's always a flip side to these policies, isn't there? Especially for specific sectors.
Indeed. Yeah, while the administration might say they're happy, some critical sectors here are definitely feeling the pain. Caleb Ragland, he's president of the American Soybean Association, sent a pretty stark warning to President Trump in a letter. Said American soybean farmers are near a trade and financial precipice. They just can't survive a prolonged dispute. And we see the effects already. China hasn't bought a single cargo of soybeans from the next harvest. That hits farmers directly. Hard. And beyond that, the U.S. is also set to increase scrutiny on imports from China over alleged forced labor in Xinjiang. That adds another layer of complexity. It's not just about tariffs.
And China isn't the only one facing U.S. tariff actions, right? India saw tariffs doubled. That feels like a very pointed move.
It does. And this is where those geopolitical and economic lines really blur, as you said. In latest oil market news and analysis for August 20, we learn Trump doubled tariffs on Indian goods to 50%. The reason cited, India's purchases of discounted Russian oil. Basically, punishment. Treasury Secretary Bessent even claimed on TNBC that some of the richest families in India benefited directly from these oil buys. But what's really fascinating here, and maybe something to think about deeper, is the contrast in treatment. Chinese refiners have also been huge buyers of discounted Russian oil. Yet Beijing hasn't faced the same public criticism, or these secondary tariffs like India has. So it raises a crucial point. Why the difference? It suggests U.S. policy isn't just about Russian oil. It's likely influenced by a whole web of things: geopolitical alignment, strategic competition, the overall trade relationship with each country, China's sheer trade volume, its manufacturing integration with the U.S. That might just give it a different negotiating position than India, despite similar actions on oil.
Interesting point. And speaking of global tensions and China, they also seem to be making a very visible display of their military advancements lately.
That's clearly highlighted in Bloomberg's piece. China teases glimpse of advanced new weaponry at military parade. China's set to show off new, cutting-edge hardware. We're talking advanced tanks, fighter jets, drones, even hypersonic weapons. It's for a big military parade next month, September 3rd, marking the 80th anniversary of the end of World War II in Asia. And it's, well, undoubtedly meant as a powerful demonstration of their military upgrades, their growing tech prowess. But it's important context here. This display comes amid these ongoing worries about corruption within China's military. President Xi Jinping has been trying to clean that up pretty aggressively. The top military body ordered a sweeping overhaul just last July, trying to restore credibility and operational effectiveness.
Okay, so moving from those big macro and geopolitical currents, let's zoom in a bit, see how individual companies are actually navigating this complex landscape. Let's start with a pretty significant development in U.S. tech, especially for a giant like Intel.
Right. According to Barron's, in an article titled Intel Stock Drops as U.S. Wants to Take Stake, Intel shares took a hit after Commerce Secretary Howard Lutnick confirmed the U.S. government is talking about taking a sizable non-voting stake in the company. This stake would be, essentially, in exchange for the billions in funding Intel's set to get under the CHIPS Act. We're talking potentially a 10% stake, could be worth over $10 billion, given Intel's in line for up to, $10.9 billion in grants. Now, what's really noteworthy here are the implications. Analyst Ben Reitzes suggests this incremental dilution might actually be worth it for Intel. Why? To be, quote, on the right side of Trump, potentially making Intel a kind of bargaining chip in future trade deals. But this raises a huge question about precedent, doesn't it? Could other big CHIPS Act recipients, like Taiwan Semiconductor, Manufacturing TSMC, or Micron Technology, face similar demands? That would be incredibly politically sensitive. Imagine a state-owned stake in TSMC. They're a cornerstone of global chip supply, deep ties to Taiwan's geopolitical position. It would blur lines of national security, economic control.
Could easily escalate tensions with China, raise big IP concerns for other tech firms. It's a really complex, high-stakes idea.
Yeah. Absolutely high stakes. And beyond Intel, the broader software sector seems to be feeling some pressure too, almost like a ripple effect.
Yes, that certainly seems to be the case. The headline Palantir stock got clobbered kind of tells the story for a lot of phosphor stocks right now. The iShares Expanded Tech Software Sector ETF, that's a key barometer for the sector, it recently fell below its 50-day simple moving average, first time since February. That's a significant technical signal, often seen as a risk of a waterfall-style decline. Rapid sell-off. Palantir, which has been a market darling, fell 9.4% in one session. It's now 16% below its 52-week high. Even Intuit, usually a rock in the software space, is showing technical stress, forming what analysts call a bear flag pattern that often suggests a downtrend might continue after a sharp fall. But interestingly, and maybe a bit of a counter-narrative, look at Synopsys. That company's still up 26% year-to-date, holding strong above its moving averages. So it suggests there are still pockets of strength, even in a volatile sector.
Okay, switching gears completely now, let's look over at China's domestic stock market. Our sources seem to suggest a pretty different story there compared to the U.S. tech sector we were just discussing.
Indeed, yeah, it's quite a positive resurgence. Bloomberg's article, Chinese stock rally broadens out as momentum picks up, shows Chinese equities are enjoying this spreading rally. Shanghai-listed stocks are up an impressive 22% from their lows back in April, and we're seeing really broad-based strength. Nearly 90% of all the index members are trading above their 50-day moving averages. What's particularly striking, I think, is the percentage of stocks hitting new one-year highs. It's at levels we haven't seen since 2021, maybe even 2020. This really points to growing confidence in the underlying fundamentals. We're seeing investors rotate out of the more speculative small caps, think the CSI 2000 index, and into more mature companies in the CSI Small Cap 500 index. It suggests a more confident, fundamentally driven rally over there.
Interesting. So from China's market rally back to individual companies here in the U.S., Ford seems to be facing a pretty significant challenge, particularly around its dividend. Sounds like a complex accounting story.
It absolutely is.
Yeah.
The Wall Street Journal dug into this with Ford's dividend looks hard to maintain even with bespoke accounting.
Oh.
And it points at a really telling situation. Ford's on track to pay out 75 cents per share in dividends this year.
Yeah.
Okay, but they've only reported 11 cents of earnings per share.
Wow, that's a huge gap.
It's glaring, right? And add to that pressure, tariffs alone are expected to slice $2 billion off their pre-tax earnings. So to somehow justify this dividend payout, Ford is using this non-standard metric they call adjusted free cash flow. Now, they publicly aim for a 40–50% payout of that adjusted metric. But the reality, year to date, their actual payouts, $1.8 billion, have significantly exceeded their reported adjusted free cash flow, which was $1.3 billion. So it really highlights how much they are, well, stretching their accounting to keep that dividend going. They're excluding significant things like restructuring costs, pension contributions, things you'd normally consider operating activities, and they're including other cash inflows that the journal notes are, quote, impossible for investors to parse.
So what's the takeaway for investors there?
Well, the implication's pretty clear. This kind of financial gymnastics, just to maintain a dividend, can signal underlying weakness. It might not be sustainable long term. And it could definitely impact investor confidence down the road if the true financial picture becomes clearer.
Right. Okay. And on the retail front, Lowe's made a really significant acquisition. Looks like a strategic shift for them.
Yes, that's right. Bloomberg reported Lowe's to buy foundation building, an $8.8 billion cash deal. This is a major strategic move. Lowe's is significantly expanding their focus beyond their traditional DIY do-it-yourself consumer base. They want to serve more professional customers, the pros. So they're buying foundation building materials. It's a prominent North American distributor, drywall, other essential building products. They have over 370 locations. And this move directly mirrors what their rival, Home Depot, did back in June when they acquired GMS Inc. for $4.3 billion. Lowe's also took the opportunity to raise its full-year sales guidance. So that shows confidence in the market, even with this big acquisition cost. It's a clear signal. Home improvement sees pros as a key growth area.
Makes sense. Okay, finally, before we wrap this up, any other interesting corporate news snippets from around the globe that caught your eye?
Absolutely, yeah. A few more quick but insightful points. We saw Adani Group, the big Indian conglomerate, successfully raise about $275 million in offshore debt. This was through its units, Adani Airport Holdings and Adani Ports. They got it from global lenders like Barclays, DBS, Mitsubishi, UFJ. And this really signals increased investor confidence in Adani, especially after S&P Global Ratings recently raised the outlook on 3 of its units, suggests maybe a recovery in market sentiment after that Hindenburg report mess, as per Bloomberg. Then, in the dairy sector, China Menu Dairy Co. is reportedly thinking about selling a minority stake, maybe 20%, in its ice cream brand. Ice is apparently a market leader in Southeast Asia. This potential sale could value the brand around $1 billion, maybe a strategic focus shift, or just unlocking value from a non-core asset. And finally, just a quick note from Kenya. Standard Chartered Bank Kenya saw its first half profit fall by a fifth. Why? A 60% drop in foreign exchange trading income. And that was a direct result of the Kenyan shilling staying largely unchanged against the dollar this year compared to a big 21% gain last year.
Just shows how currency stability, or the lack of it, directly hits the bottom line for banks in EMs relying on that FX movement.
Wow. What a deep dive indeed. From that really complex interplay of central bank independence and the dollar's fate, to the nuanced dance of trade policies, and then drilling right down into specific corporate strategies. It's just so clear that even a snapshot like today's Wednesday morning headlines offers this wealth of interconnected insights. It's really never just one story in isolation, is it?
Absolutely not. And this maybe brings up a critical point for you, the listener, to consider. As these global economic and geopolitical forces keep intertwining in ever more complex ways, how might those seemingly distant decisions made by central bankers, by politicians, how might they impact the very real bottom lines of the companies we rely on every single day, and maybe even the value of your own investments? Understanding these connections, these linkages, it really is key to navigating the financial world today.
Indeed. Definitely something to ponder as you navigate your own financial landscape. Thank you so much for joining us for this deep dive into today's major financial magazine headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.